What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to talk about something called a partial asset disposition. What this allows you to do, just like it sounds, it allows you to dispose of and write off as a loss a portion of an asset. So let's talk about a hypothetical. Let's say you purchase a piece of real estate that you bought in, say, 2010. Included in the purchase, we're going to say this is a residential rental property. Included in the rental property are the building structure and all the major components. One of those components would be the roof. So this is included with the building on your depreciation schedule. This is typical that you're going to purchase the building, you're going to break out a piece for land, and then everything else is going to go to the building and be depreciated over 27 and a half years. That we see all the time. Now let's say here we are in 2024 and that roof needs replaced. So you go out and you spend $20,000 for a new roof. You capitalize the roof, you add that to your depreciation schedule at $20,000. Well, now you're technically depreciating two roofs. The first roof, purchased in 2010 when you bought the property and included in that building asset, all the other major components of the building. And now this new roof that you just put on this year, that's added to your fixed asset schedule for $20,000. So you're depreciating two roofs. Well, with a partial asset disposition, it gives us a answer, a solution to fix this. So you can find the guidance here, you can find the support here in Treasury Regulation 1.168I-8, which tells us you can deduct the net tax basis on the original roof as a loss on disposal. So to do this, you need to be able to allocate a portion of that original building cost to the roof and adjust for the prior depreciation taken. A portion of the depreciation you've taken against the building would be allocated to that roof. Now, when you do a partial asset disposition, it has to be done on an originally filed return. This includes extensions. Basically, you cannot go back and amend to fix this. So if you're using the partial asset disposition, you also get to deduct things like removal costs, like transportation and dump fees, those costs that take the old portion of the asset, in our case, a roof, out to remove it and dispose it. Generally, those costs are capitalized. But if you're using the partial asset disposition, you are allowed to deduct those costs as well. Now, the amount of the loss you're allowed to take on a partial asset disposition has multiple ways. There's basically multiple ways you can determine this. Now, if you can actually identify the true cost, the actual cost, that's what you're supposed to use. That's what you need. It's actually required. However, that's not always the case. So you can use one of the reasonable methods that Treasury gives us in the regulation. So there's three of these reasonable methods. There's something called the producer price index, which basically allows you to discount the cost of a replacement asset, in this case a roof, and it can discount it back to its place in service date. Now, if you aren't intimately familiar with construction costs, don't attempt to try this on your own. You can end up with a wildly different number than what would be true. Another option is replacement costs. So you can find what the cost is to replace the entire asset, so the piece of real estate in this example, and do a pro rata allocation for the roof. Again, if you're not really familiar with this stuff, then it's not the best way to go, and it's not something that's going to be cheap to hire someone else to do. Which brings us to option 3, which is by far the best and the most cost effective. You do a cost segregation study. Now, we've talked about cost segregation studies on here before. Basically, the cost segregation study allocates a portion of the entire building cost to various assets. One of those would be the roof in the example we're talking about. It's also used to identify assets that are 5 and 15-year property that can be used for bonus depreciation. However, in this case, when we're talking about the partial asset disposition, the cost seg study also comes into play. So really beneficial here. So let's just talk through a brief example. Let's say you spend $100,000 on a rental property. This is excluding land. We're just keep things simple, just the buildings, the $100,000. The original roof represents $8,000 of that purchase price. So $8,000 to the roof, $92,000 to the rest of the building. Now the roof is replaced after 10 years, and at that time, depreciation taken to date is $36,364. That's the total depreciation for the entire building. Of that, $2,909 is allocated to the roof. Using a partial asset disposition, you are able to deduct $5,091 as a loss on partial asset disposition. That's the $8,000 original cost of the roof minus the depreciation taken to date, the amount that is tied to the roof, $2,909. That leaves us a net tax basis of $5,901. So the original asset cost minus depreciation taken to date gives us the net tax basis for the partial asset disposition. The new roof would be capitalized and depreciated as usual. You're going to put it on and depreciate it over 27 and a half years. We're assuming this is a residential property. But you get this $5,000 write-off as a partial asset disposition in the year you replace the roof. Now, talking about roofs, there's something else called qualified real property. So these are improvements to non-residential real property. This is going to apply to commercial roofs because we're talking non-residential real property. Under the qualified real property, there are 4 different pieces of or types of assets that qualify. So you have roofs, HVACs, fire protection and alarm systems, and security systems. So this is all qualified real property, only applies to non-residential real property. So it's improvements to non-residential real property. So improvements are made after the original purchase. This qualified real property, or QRP, is eligible for Section 179 depreciation. So you can use Section 179 to write off the cost of that new roof and in the same year, deduct the loss for that partial asset disposition. So just something to think about if you have a commercial property. And remember, Section 179, you can only use it to the extent you have income. So it's not going to create a loss like bonus depreciation. But I thought that was cool just to throw in the qualified real property and the Section 179 piece since we're talking about writing off a roof and the partial asset disposition. So that about does it for today. I hope you found value in this episode. If so, please leave us a 5-star review and hit that like and subscribe button. Until next time, have a great day. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulicegroup.com/contact. That's ThePulicegroup.com/contact.